Welcome to this tutorial, and in this tutorial I'll be sharing with you accounting for leases, which is International Financial Reporting Standard number 16, which requires that all assets should be all leases should be recognized as assets and liabilities if they have a period of more than 12 months, which is one accounting period, unless the asset is of low value. All right. So now I'll go straight to the example to show you how we basically account for the lease under International Financial Reporting Standard number 16. And on the screen here is the example, which reads, XYZ Copper Mines in Zambia enters into a 5-year lease contract of a machine which has a remaining useful life of 10 years. Lease payments are 50,000 per month. So every month, per annum, sorry. So every year, the company is required to pay 50,000 under that lease contract, payable at the end of each year in arrears. There are two types of leases. In the other video, I will indicate if payment is happening in advance, how it should be accounted for. The lease incurs initial direct cost of 20,000 and receives lease incentives of 5,000. Okay, so meaning at the point of entering into the lease contract, there was an initial direct cost of 20,000. This will be attributable to the lease itself, and also the lessee received a lease incentive of $5,000. The interest rate implicitly in the lease is not immediately determinable, but the incremental borrowing rate is 5%. So meaning, if we cannot clearly determine the interest rate implicitly for this particular lease, we can adopt the lease incremental borrowing rate, which is 5%. So in this case, 5% will be used as the interest rate directly attached to this lease contract. Required, apply International Financial Reporting Standard number 16, lessee accounting. So there are two parties, the lessor and the lessee. The lessor is the original owner of the assets who lends out the assets to the lessee. So the lessee in this case is looked at as a new acquirer. Okay. So lessee accounting. So we want to see on the books of the company which has entered into this lease contract, how they are going to account for this machine. Okay, apply International Financial Reporting Standard number 16, lessee accounting, to determine amounts to be recognized in the financial statements of XYZ Copper Mines at the end of the first year. So just requested for the first year. Let's see how this goes. So the first thing you need to do is to determine the lease liability. And the lease liability is basically the future payments converted into present value. All right. So if you can see here, the machine has a 5-year lease, and then the lease payments are $50,000 per annum for the next 5 years. So this 50,000 is happening in future. Like if it's paid at the end of the year, it simply means that the first 50,000 will be paid. If we assume this is January, it will be paid in December. So there is 1 year lapse. So that makes it the future payment. So we've got 5 future payments that we are going to convert into present value. If you remember your accounting principles for management accounting, where you calculate the present value, and also those doing financial management, where we calculate the present value, this shouldn't be an issue. But however, I have indicated the formula which helps us to calculate the present value is basically 1 plus R, close brackets, and then raise to the power negative n. This we call it as the discount factor. When multiplied with the future value, it gives us the present values. So like you can see here, in year one, I've indicated 50,000 there, multiplied by the discount factor for year one. 1 plus R, our rate, I indicated to say we adopt 5%, which is 0.05, raise the power negative 1 because it's for year one, and it gave us $47,619.05 for the first year. For the second year, as wise, 50,000, raise the power negative 2. So we are just changing the number of years, raise the power negative 4, negative 5, and then we have all these present values of the future payments. When added together, these present values for the future payments, they give us 216. So the 216, $473.83 becomes our lease liability. So the lease liability is very simple to calculate. You just convert the future values of the future payments into present value, and then you add them together. Then you have the lease liability, and this lease liability is at the beginning of the year. Now I indicated alternatively, if you are brave enough, you can use a shorter formula which says this liability is equal to annual payments, open brackets, 1 minus open brackets 1 plus R, close brackets, raised to the power negative n, over R. All right. Now this one is also a discount factor, just like this one here, just like this one. Now this one is when we are accounting for payments independently or one-offs. But where we do this is when we are given an opportunity, we all know to say if we have the same amount, it shall be called an annuity. So if you see we have the same amount there, 50, 50,000, 50,000, 50,000 there. So this is called an annuity, and there is the formula which can be used to calculate the present value of the annuity, which is this one here. Okay. So now this one is the one that I prefer more, but most students dodge it because of the formula, but the formula is easy to remember. It's not a very difficult formula, as you can see. So we'll say lease liability 50,000, and then brackets, and then we say 1 minus open brackets 1 plus 0.05 close brackets raised to the power negative 5 over 0.05. So if you are pressing on your calculator, you basically start with this part. And when you're doing this part, start with the top part alone. When you combine everything at the same time, both mass will take place. You find the division will come first before subtraction and something like that. So we begin with the top part, 1 minus open brackets, 1 plus 0.05, close brackets, raise to the power negative, how many years are involved? Raise to the power negative 5. Raise to the power negative 5. Raise to the power negative 5. Yeah, 1 minus 1 plus 0.5 raise to the power negative 5. I have 0.216473. It's going on like that. And I'll simply press divide by 0.05 like that. And then I say equal to. After I found the top part, and then I'll divide later. And then I have 4.3294. And then I multiply that by 50,000, and I'm obtaining 216,473.83. Okay. So this number is the same as these ones here. So this is what has basically happened. So I proceed now to show you how the lease gets to be amortized. So you see, if you look at this one, 216, it will become the opening balance of lease. So we have the opening balance there, which is we're assuming this is 1st January, and then we need to calculate the interest rate. The interest rate of this amount, 5% of that is 10,823.70. This interest is the one which goes under finance cost in the income statement. You see the extract of the income statement. And then we have the annual payment, which doesn't change, 50,000 go through up to year 5. So what we're doing here is we are saying opening balance, which is $216,473.83 plus interest charged for the year, which is 10,823.70 minus the payment that we are making. We're arriving at 177,297.50. That should be end of year, and this is December 31st, I should guess. All right. So now this payment, which is here as the closing balance, becomes the opening balance for year 2. And then the process continues. We multiply this opening balance by 5% to give us the interest rate for the year in year 2, which will go under finance cost in the income statement, and then less the payment, and then we have 136. And the process continues. This 136 comes here, and the process continues. We're up to year 5. Have you seen at the end of the year, you have a 0 there, simply indicated to say you had prepared the lease schedule or amortization table correctly, and this is what basically happens under the new standard, International Financial Reporting Standards number 16, which is accounting for leases. All right. So here I was just showing how the liability will be melted. But now I want you to take note that we need to indicate the liability for the first year in the books. So the liability which will be indicated is 177. Now I want to indicate to say in this 177, the liability which will be indicated in this 177, there is actually current and non-current liability. So it has to be split into 2. Now, if you see, the next balance will be 136. Okay. So now, between now and next year, December 31st, the lease will have reduced to 136, 162. So we will take this part, this one, the 136, 162, as a non-current what? Liability, because it's not being paid within 1 year. It's paid after 1 year. So now we want to figure out what was it that was paid from this amount for this to come to reduce to this in year 2. That which was paid from the 177,297 will actually reflect the current liability. Okay. If you heard my explanation properly, I said the non-current liability at the end of the year is 177. And this 177 is being split into 2, current and non-current liability. But the total lease liability at the end of the year is 177,297.5. So now, if we do that, I'm bringing you here. You see, that's the total liability that will be indicated in the statement of financial position, which will be split between non-current liability, which is the balance for the following year. Have you seen? And then once we know the balance for the following year, we are able to tell how much was paid for from 177 to arrive at 136, which is the balance for the following year. So that amount which was paid shall be regarded now as the current what? Liability. So ideally, what I'm trying to explain is that the total liability is 177. And then if we pick the closing balance for year 2, that becomes the non-current liability. And then we need to less from the 177 to identify the current liability. That's how it shall be extracted. That's how it shall be recorded or accounted for in the statement of financial position. So now the income statement extract, we have 2 things there. The other one I'll explain it as I talk about the right of use asset. But this one we've already talked about it, which is the finance cost, the interest. It shall go under expenses. Under expenses, under the theme finance cost. This is the 10. That's for year 1 alone. Okay. Right of use asset is basically the total of lease liability plus any other cost that could have been incurred in the acquisition of the lease, less any direct cost attached to that lease, add any direct cost attached to that lease, and then we shall list the lease incentives. The lease incentives, they're like just benefits that we obtain from acquiring the lease, and it acts as a reduction to the right of use asset. So the lease liability we already calculated here, lease liability we already calculated here, which is 216,473, plus any other cost, the direct cost which were incurred, which is the 20,000 here, minus lease incentives, they'll give us the right of use asset. So lease liability, which we have already calculated, plus direct cost attributable to the lease, 20,000 minus lease incentives of $5,000, we arrive at the right of use asset, which is 231,473.83. And then we're going to depreciate this asset over a period of 5 years. Usually, most students, I want to put a precaution here. Most students, they go and divide by 10. 10 years, of course, is the remaining useful life of the asset, but this 10 years does not reflect the tenure which the company will have this asset in use. The tenure which the company will have this asset in use is 5 years. So when we are calculating depreciation, we calculate it at 5 years because that's the time that the lessee company will be accounting for this lease. So I pick 5 and not 10. I don't pick the useful life. I pick the life at which we shall use the asset in the organization. And I calculate the depreciation charge to be that. So this being the depreciation charge, it goes under expenses. And usually depreciation in a typical exam question for financial reporting, they'll guide us where it goes. Mostly for plant and machinery, the depreciation is attached to cost of sales because plant and machinery, they are the ones that produce the products that we're manufacturing. But if it's buildings and offices, most likely it will go to administration or administrative expenses. And then if it's for motor vehicles, running expenses and depreciation for motor vehicle will go to distribution cost mostly. So I'm not delving into that so very much. I just wanted to indicate to say that's the depreciation that shall be charged to the income statement. And then the non-current assets, this is the non-current assets, which is the total right of use asset, but this is at the beginning of the period and 1 year has passed. So we are assuming from January to December, it will have depreciated by that much, which is the depreciation per annum. And then we shall subtract 231,473.83 minus 46,294.77, which is the depreciation, to arrive at the book value of the asset, which will fall under the non-current assets with the heading right of use asset, under non-current assets, right of use asset. Thank you so very much for attending this tutorial. For more videos, you can subscribe to my YouTube channel.